in order to understand what we do into the Fed, into Jackson Hole, we have to understand what we did last week. What was leading the rally for the dollar?
Well, I think what we've seen really over the past week and a half is a shift from the market trading the dollar for growth reasons, which we saw earlier in the year. We even saw that earlier this month on back of the labor report, to trading the dollar for safety reasons. And there's clearly a lot out there to be concerned about right now. We have the concerns around the Delta variant, extended lockdowns, what that means for the economic recovery. We have taper trust issues, clearly a couple big weeks coming up here between Jackson Hole and then the September Fed minutes. There are concerns. Will they go earlier? Will they go faster? And then last week with geopolitics again rearing their head, that's certainly not helping the overall risk sentiment. Now, coming into this week, we've gotten some decent reports out of China around the COVID situation being under control. We had some better data out of Asia. You combine that with Kaplan comments on Friday talking about the Delta variant and the impact it's having on activity, return to office, hiring. And you look at that in addition to the most recent CPI report, and really, it's kind of taken the more hawkish outcome at this upcoming Jackson Hole off the table. And that's exactly why you've seen the dollar index come off the highs since the start of this week.
Kristen, another factor behind all of this, and if you break down the dollar index into its component parts, we haven't seen a big move in euro dollar, but what we have seen is a big move in the commodity currencies. And I'm looking at why that would be. Clearly, obviously, a factor is what China has been doing and the concerns around the growth slowdown there. More broadly, the Delta slowdown that could be produced in the United States as well. How much of what we're seeing this week is just simply a bounce back for oil, iron ore, all those factors coming into play, boosting those commodities back to where they once were?
Absolutely. I mean, listen, the commodity currencies and the commodity segment has really been beaten up over the last couple of weeks. Again, you have the concerns around, like I earlier mentioned, the lockdowns. The China narrative is serious. I mean, we just made some significant downgrades to our GDP outlook, and that clearly is going to have an impact across the complex. What we're seeing over the past couple sessions is a bit more of a relief rally because, again, we've taken that kind of hawkish outcome off the table at this upcoming Jackson Hole, given some of the recent data, given some of the mixed messaging from the U.S. data in particular, and some of the Fed comments as well. I think people are a bit more comfortable with the fact that we're at least going to get through this week without a more hawkish surprise, and that's why you're seeing the commodity complex come back a little bit.
Either way, Kristen, when we get any signal from the Fed, where is the risk? I mean, yesterday and last week was so striking because yields did absolutely nothing. And it was the dollar, it was the FX market that had their own little taper tantrum. What's positioning and what's the vulnerability?
Listen, it's hard to see a situation in the near term where you see an unwind or you see a retracement of this dollar appreciation that we've seen as of late on back of, again, the Fed narrative and the safety concerns. This is exactly why over a longer term, investors tend to maintain an over allocation towards U.S. assets. It offers both growth and safety. That being said, the dollar is already in overvalued territory. So it's not like you're going to expect a big impulse here higher either. So really what we're looking at across G10 is a bit more of a consolidated range trade. Perhaps you'll get a little bit of differentiation based on central bank policy, who's going to follow the Fed, who's next. And in emerging markets, again, it'll really be the focus on which central banks have a more credible inflation policy.
The euro dollar has added a big figure in the last day or so. We got down into, what, 116.64, I think was the low over the last 5 days. Kristen, what is the downside for euro dollar? Where is the base on that? The ECB is nowhere near even talking about tapering. It's going to change its policies around PEP a little bit, but it's miles away from any kind of significant change and even further away from a rate rise.
Well, that's exactly right. It's very difficult to be bullish on the euro here, given a very dovish ECB. To your point, the inflation outlook there is mediocre at best. That being said, the downside is supported for a variety of different factors. Number one, you're going to have asset inflows. European equities still look attractive on a liquidity basis, on a growth basis. And again, any time that you see the euro really come off, those inflows are absolutely happening. You have European corporates that tend to use that dip in the euro to add to their hedge ratios. And lastly, when you're seeing a broader risk off move, It's not too uncommon actually to see the euro rally. And the reason being is as people are adding risk, as they're going into long EM positions, into long commodity currency positions, they typically use the euro as a funder, given it's a low yielding currency. So when you're seeing these periods of risk off, and when clients and investors are deleveraging those positions, they actually have to buy back those euro shorts in order to reduce their risk. So that's exactly why you didn't see a further extension of the euro downside last week.